Good morning, everyone. This is Windsor Brokers Live Daily Market Outlook for Monday, 25th of March, 2013. Very important day. As expected, the top news come else from our homeland, Cyprus. As I said, as expected, the deal was reached minutes before the deadline that was imposed by Eurozone. Cyprus and the European officials clinched the last-ditch deal with international lenders and avoided the worst scenario that was on the table. That was meaning a collapse of the banks and the bankruptcy of the state itself, as well as possible Eurozone exit. As said, the agreement was reached to shut down the second largest bank, Cyprus Popular Bank, also known as Laiki, and inflict heavy losses on uninsured deposits, including wealthy Russians, in return for a 10 billion euros bailout. As said, the agreement came just hours before a deadline to avert the collapse of the banking system in tough negotiations between President Nikos Anastasiadis and the heads of the European Union, the European Central Bank and the International Monetary Fund. Swiftly endorsed by Eurozone Finance Minister, the plan will spare the Mediterranean island a financial meltdown by winding down the largely state-owned Popular Bank of Cyprus and shifting deposits below 100,000 euros to the Bank of Cyprus to create a so-called good bank. Deposits above 100,000 euros in both banks, which are not guaranteed under the European Union law, will be frozen and used to resolve Laiki's debt and recapitalize Bank of Cyprus through a deposit equity conversion. The raid on uninsured Laiki depositors is expected to raise approximately 4.5 billion euros, according to the comments of the Eurogroup chairman, and the Laiki will effectively be shattered with thousands of job losses. Officials said the senior bondholders in the Laiki would be wiped out, and those of Bank of Cyprus would have to make a contribution. EU spokesman said no across-the-board levy on the tax would be imposed on deposits on Cypriot banks, although the hit on large accounts holders in two biggest banks is likely to be far greater than initially planned. A first attempt at a deal last week collapsed when the Cypriot Parliament rejected the proposed the plan of European Union. Government of Cyprus spokesman said we averted disorderly bankruptcy, which would have led to an exit of Cyprus from the Eurozone with unforeseeable consequences. As immediate result, I would say that most of the action has been priced in, as the euro is slightly lower at the beginning of European session after hitting highs above 130 barrier. That was briefly cracked on last Friday, and the close around this area kept a positive tone for the single currency as it attempted to break above 1 week range established after previous week's strong gap lower opening. But the downside has so far been well contained on the 128.42, and the crack of 130 with 130.47 seen so far during the overnight session sees more potential now towards the upside, despite the current pullback that is still within the certain limits. Just to mention that today there is absence of absence of economic indicators in the calendar, except the comments, except the speech of Fed Chairman Ben Bernanke, who is due to speak at 17:15 GMT. Nothing more significant for the first day of the week, so we will mainly focus on the technical part and see what we can expect in the next 24 hours movements in the major currencies and the commodities. As usual, we start with the single currency, and we're going to take a look now what were the movements since last Friday closing. As said, the euro closed around the 130 zone last Friday. Exact closing price was 129.88, a slight dip lower on opening, and then a strong rally above 130 again. 130.36 reached, 47. That marks retracement of 76.4 of the entire fall from previous Friday's peak at 131.06 down to 130.28.42. Now positive tone has been established as shown on the hourly as well as 4-hour chart as indicators now broke above their midlines. Current pullback is more affected on the hourly indicators and seen likely as a technical pullback due to overbought conditions, as we can see that RSI now is reversing down from the overbought territory and moves below its 7 days moving average, while the other indicators are also in descending mode. Initial support is a previous range top that has nearly been reached, 129.80, and holding this is the first support. Then we have the overnight low at 129.60. I would say the current positive tone should not be harmed by the pullback in case that dips will be contained somewhere above 129.50, which is seen around the 50% retracement of the rally of last Friday's from last Friday's 128.87 to overnight's high at 130.47, and this is also reinforced by 55 days moving average. This is seen as a good support, and any dip lower would again bring at risk the previous range floors that are at 128.80 and 128.42, as well as 200 days moving average currently at 128.74. So we have quite good support at this point, while the daily chart also shows quite strong signals of recovery as the price broke above the triangle and then is establishing a beginning of the reversal pattern that of course needs completion of another 2 days in order to confirm, with the 20 days daily 20 days moving average now being cracked at 130.07. More work towards the upside requires of course a break above 131.06, 131.33 to confirm this the end of this phase, to confirm the bottom and open way for stronger recovery towards the upside, with the set 4-hour indicators now being in the positive mode, still unharmed by current pullback. We need to hold above somewhere, as we said, around 129.50. These are also the previous lows in order to keep the traction of the recently established bullish tone and possibly to look for a test of our breakpoints at 131.06, 131.33. Also important to mention that last week's gap hasn't been filled completely yet, and this is also seen as a disadvantage at this point. We need to see the regain of 130.77 last Friday's closing, previous Friday's closing price, in order to confirm the bullish stance and the open way for more significant corrective action of the larger down move from 137.10, which is the high of the year 2013, and down to 128.42. Another supportive element is that 200 days moving average so far contained the downside, held the downside protected, and this is giving more credentials to the current bounce higher. Of course, break above 31.06, 31.33 is required to confirm. Also, British pound against the US dollar holds a positive tone. We have some pullback at the beginning of European session this morning, similar to euro, but more important thing is that the price bounced above its recent range top, which was around 151.70.80, regained the 152 and 152.20, as well as very important levels, which is the base of the previous multi-year range at 152.30, previously break of which was initial signal of stronger weakness, as the pair remained supported at this level since 2010, and despite after a brief break lower, the downside was well protected here. We can see the several attempts that failed. Final break here that extended down to 148.30 and retraced 61.8% of the larger multi-year rally from 135.01 to 70.41, is still keeping the bearish tone favored at this point. Back to the lower time frames, daily structure is now gaining traction as indicators are pointing higher, and the price cracked 152.30 initial resistance. Of course, more work is seen towards the upside. Regain of minimum 153, I would say, is seen as a confirmation for this rally, as the phase from 152.20 down to 148.30 has been completed. The decline fully retraced, and we are looking now for a fresh leg higher, as the base now is confirmed at 148.30. A stronger recovery is seen likely at this point. For our chart studies, maintain a positive tone, with the price being held supported and underpinned by 20 days moving average currently at 151.80, and the bullish 2055 moving averages crossover is underpinning the action. The previous range tops at 151.80 are now acting as initial support, along with 152 round figure support, while any dip lower should be contained ideally by 150.72, which is the previous range floor, in order to keep the bulls in play. This also marks approximately close to 38.2% retracement of the entire recovery rally from 148.30 to 152. The highest was seen 152.59. Ideally, dips should be contained somewhere above this level in order to keep the bullish structure in play. Otherwise, break below 150.70 and 150.50 would revive bears again. So far, positive tone sees more focus towards the upside, with the clear break above 152.30, 152.67, which is one of the previous range lows, and regain of minimum 153 will be confirmation that we are back into the bullish tone, and a stronger recovery to be anticipated. From the other side, dollar yen, let's take a look. The pair remains weak following the upside rejection at 96.70. This was the highest so far seen, posted on 12th of March 2013, and since then the pair has been declining. The latest action seen last Friday sees more rift down towards the downside, as basically last week's gap lower opening hit level lowest level at 94.30, and then subsequent recovery failing to clearly break 96.00 now sees more risk towards the downside. Last Friday's low, marginally fresh low at 94.18, sees increased risk of further stretch lower. 94.00 as a round figure and psychological support seen first, and then we have 93.78, also very important, 50% retracement of the entire recovery rally from 90.85 to 96.70. With the negative tone seen on the 4-hour chart and the bearish moving averages crossover now keeping the upside limited. The 95 zone so far offers good resistance, and so far capping the upside. More risk seen towards the downside according to the 4-hour indicators. Hourly studies are also quite negative at this point, as overnight price action again failed at on approach to 95.00, being capped by descending 55 days hourly 55 days exponential moving average, and now losing the 20 days and 10 days once, seeing again more potential towards the downside, as most of indicators are pointing lower. MACD is below the midline. RSI is somewhere in the neutral territory, but still holding below the 7 days moving average. Some momentum has been regained on the recent rally seen since last Friday and overnight. I would say at this point still not enough to confirm any stronger recovery. From Fibonacci levels of the latest down leg from 96.12 down to 94.18, 38.2%, which is around 95 round figure resistance, now offering a good barrier, along with the last Friday's high at 95.12 and also close to 50% retracement. I would say break above 95.15.20 will be confirmation for some stronger recovery and will avert immediate downside risk of sliding below 94.00. However, we have to notice that a negative tone that still dominates on the 1 and 4 hour in chart charts is still keeping the downside favor. Basically, the levels to look at this point are 95.00, 95.20 on the upside, and pardon, 94.18, 94.00 on the downside, a break of each side. As we can see, there is a sort of a triangular consolidation developing at this pardon, at this point, and basically break of either side will define the immediate direction for the pair. As said, near-term indicators are still more negative and still see more risk towards the downside. However, break above 95, 95.20 will bring some more positive tone. Conversely, break below 94.18, 95, 94.00 is to signal a further retracement, a further extension of the down move from the lower top at 96.12. Aussie dollar remains well supported for now as it ended the week close to its highest levels. As we can see, the Fibonacci, Ichimoku studies on the daily chart are very positive as the pair broke above the cloud top, which is at 104.11, equivalent to the previous highs, and the faster moving average Tenkan Sen has broke above the slower one Kijun Sen. That is an additional positive structure. Of course, still we have to see the Tenkan Sen moving above the cloud also to confirm the bullish stance, but overall tone remains very positive as the pair posted the fresh high during the night session at 104.66 compared to the 104.58 last Thursday, Friday's highs, where we had a brief congestion, I would say consolidation, with the downside being protected at 104.20, and the more positive tone is expected to extend up towards our next upside targets, 104.72, and finally 105 as round figure and psychological resistance that are in the near term focus. A positive tone persists on lower time frames and keeps the upside favored for now, while any reversal should be contained, should not exceed the levels at 103.42, which is the previous range floor, in order to keep the immediate bulls in play. Otherwise, we may see the delay in the current bullish rally that is so far unobstructed and is looking for test of the upside targets 104.72 and 105.00. Quick look at dollar Swiss. That remains under pressure following a reversal of a recent peak at 95.65. Similar to dollar yen, the pair exceeded the previous low of the previous week at 93.77 and 93.51 seen so far, retracing 38.2% of the recovery rally from 90.20 to 95.65, with the negatively aligned indicators on lower time frame studies, both hourly and the 4 hour, seeing more pressure towards the downside at this point, as especially on the 4 hour this is quite evident. We have also the bearish crossover of 20 over 55 days moving average that limits the upside for now. Any bounce higher requires break above 94.90, 95.00 in order to avert immediate downside risk and shift focus towards 95.00. Otherwise, further extension lower below the recent low posted last Friday at 93. Pardon, this morning, early at the beginning of the Asian session at 93.51 would risk a test of important 93.00 psychological support, also 50% retracement below, which we'll be talking about formation of the top, as we are already seeing the sort of failure swing formation at this point, and the brief break. We still don't have the clear break of the previous low at 93.77 is required to confirm the pattern and open way for further extension lower. Also break below 200 days moving average that is currently at 94.19, and the weekly close of last Friday below 200 days moving average favors bears. At this point, descending indicators on the daily chart and the loss of initial bullish momentum keep the downside favored for now. And as said, only break above, clear break above 95.00 would avert the downside risk and shift the focus again towards the upside. Initial barrier at 95.65. From commodities, crude oil, crude oil remains well supported for now. If we take a look on the 4-hour chart, then we can see ADX studies are showing bulls firmly in play as the price attacks again the recently established range top at 94.47, with the downside being protected at 92 zone. This is also the previous range floor and offers quite good support for now, able to contain a strong pullback of 94.45 seen last week, with the positive tone being established. We can see it on the 1 and the 4-hour chart, keeping the upside focused. The pullback on attempt of pullback seen on the overbought hourly indicators that are quite extended at this point might see some corrective action down towards levels previous 23.6%, which is approximately close to the previous high of 20th of March, and then a more significant 93.30 that marks 38.2% of the rally from 91.82 to 94.23, reinforced by 55 days, ascending 55 days exponential moving average. This is seen as ideal reversal point, and then it dips below here with weakened structure, and basically will signal that the price is so far lacking strength to break above the range top established at marked at 94.45. Otherwise, reversal at or above these levels, 93.30, will still keep the positive structure of 92 of rally from 91.82, and they will look for a possible break higher. That we'll be looking for test of 95.00. It's our next upside target that marks 61.8% retracement of the entire down leg from 98.63 down to 89.35. Daily 55 days exponential, daily 55 days simple moving average so far limits the upside, and break here is seen as a initial. It's currently at the same level with the previous high of 19th of March 2013, and the break here as a stronger resistance is seen as a trigger for further recovery. 95.00 seen as the next target. On the downside, 90 days moving average so far contains the dips, and it's currently at 92.15. As said, the 92 zone is seen as a quite strong support, and only break below this level would have a more significant impact on the oil's price, and would signal further weakness, where we're looking for test of 91.00, which marks 200 days moving average. And finally, the yellow metal, let me just find it. It's still, I would say, on the 4-hour chart, you can see that the gold is still within the consolidative range after hitting fresh high at 1660, and the 16.00 is initial and strong support, reinforced by 55 days moving average of 4-hour chart. Keeps the downside protected, so we are basically in the range. However, weakening 4-hour studies and the already negative hourlies that are pushed lower after an unsuccessful attempt during the Asian session higher, 16.13.47 seen so far, and the quick reversal lower sees the downside slightly more at risk rather than upside. But as said, quite a neutral tone is still seen, and the consolidation is still seen between 1600 and 1660, as the price is still shy of a very important 1620 resistance. That is high of 26th of February, as well as 50% Fibonacci retracement of 1684 to 1554 descent, and basically break above this level will signal resumption of the uptrend recovery rally from 1554. That is a low of 21st of February 2013. Currently, the price has been limited at 76.4 Fibonacci expansion of the third wave that commenced from 1564, and then break above 1520. We'll be looking for a test of another important level. 1631 is the 100% Fibonacci expansion, also reinforced by descending daily 55 days moving average. So we have quite strong barriers at this point. 1616, 1620, and 1631. Break of the later is basically to confirm the recovery and the signal stronger rally to avert immediate downside risk. As the yellow metals price approached very important support and the multi-year support and the critical support at 1520, low from since that keeps the downside since September 2011, and basically break below this level will be seen as a trigger for some more significant pullback of over 10 years. A strong rally that hit so far $1,920 per ounce. This was the high of September 2011. As said, break above previously mentioned levels is to avert immediate downside risk. Otherwise, the generally negative tone still seen on the yellow metal. As we can see, the Ichimoku studies are still well in the negative territory and seeing more downside pressure. Stronger recovery through 1620, 1631 is required to avert this risk of possible revisiting 1554 and then 1520. And that's all from my side. I think we covered the most important instruments and the points. If you have any question now or comment, please, you can send it. Otherwise, we will conclude today's session and leave some space for our colleagues that will be doing it in Arabic. Okay, it seems that except thanking me for the session, there is no questions, everything nice and clear. We are happy that deal for Cyprus has finally been reached, and we had a sort of fear these days about the future of our country. Now it's a bit easier to breathe, and we hope that things will come in order, especially when the banks open tomorrow, and we'll be all able to go and get some money. So far it was only through the ATMs and the credit cards. Wish you nice Monday, nice beginning of the week. Of course, a lot of success in your trading, and we will see you back again tomorrow morning at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Good luck.